Let's
So
start.
let's start. Good evening, members, and welcome to everyone on behalf of ICI Dubai chapters and the managing committee. Just now, before me and Bekansh and Sanjay bhai were talking, many of you must be a little bit like confused ki why we have put this playbook in the same sentence. But it's not a match. But I feel when it's any one area where we can use playbook word, I think it's the indirect text. And there is an interesting fact also. We all know that the introduction of the weight introduced in 2018. And after that, if you will see, we are sitting in 2025. The UAE tax landscape has changed dramatically. We have seen the continuous updates, FTA clarifications, also even the court ruling that shape, how must business complies. So the reality as a chartered accountants for us and for the client's perspective also that sometimes the mistakes are very costly, whether it is a VAT returns or whether it is a excise obligations and the custom reconciliations. So just a fact that in 2018 the FTA have collected around 30 billion VAT in the revenue in the first year alone, and in the 2024 you will see it was more than 350 billion. So the reason why I'm saying that when the revenue is getting higher and higher, so the compliances part, the FTA is always taking care when they are seeing. So the much the scrutinies and all they are coming. So it's about the protecting the business of the clients from the penalties, identifying the opportunities for the saving where we can save for our clients and guiding them with the strategy. So today's session is all about that. The expert is going to talk about that, I think, and the practical case studies are there. And I was talking with the Ekansh, so he said like he's going to take some polls as well. So without further ado, I'll just go to our chairman for his thoughts. Over to you, Jai Bhai.
Thank you, Amit. Thanks a lot. I'll not take much of the time. I love the fact when I'm seeing few names there who were not there in physical events but are joining in. That was the entire motto of starting these virtual sessions along with physical sessions. Physical sessions, yes, we meet and we are able to uh, talk and laugh together. But learning can happen across platform, and that is the idea. This year, committee came up with these virtual events, and I love seeing the few names which I mentioned as well. Which I mentioned as well that uh, are there on the camera or on the or online portal. That is lovely, and I want to see more and more of our members. The engagement has to be there. Now, why this topic? Obviously, city filing is going on in full swing. Everyone is worried about city. But let's not forget there are certain updates which is coming on VAT part, on the excise part, as well as on the customs part. And everyone, all three, along with corporate tax, plays a interlinkage play around it. We need to understand what's happening around. Doing one compliance, missing on the other will not give us the results which we want. We want our members to know all about compliances from VAT to city. Yes, city is our priority this month, but we cannot leave VAT custom excise back. That's why we said, and I can't, and thanks to accounts to come forward and say, Jay, I will take it up. He is also busy with city returns, but he said, yes, VAT is important and we'll take it up. One more person whom I should thank is Sanjay. Sanjay is always behind me for VAT sessions and taxes sessions, and he wants to ensure that something or the other happens. And the result you are seeing today is a virtual session on VAT. Couple of days after, on Saturday, we'll be meeting in person for a city session, again done by arranged by Sanjay. So that is what my committee is doing. They are taking care of their returns of their clients, but they are also taking care of our members. Thank you, Sanjay ji, for organizing this event, as well as again I'll say thanks to you for day after tomorrow. But thank you very much. Thank you, Akans, and one more speaker who has joined us,
Mr. Edson.
Mr. Edson. Thank you. I was looking for that name. Amit, you guessed it right. I was missing that name. Thank you for that. And Akans, you are doing a good
Thank
job.
you so much. Yeah, thank you so much, Jai Bhai. And let's go to, I think, the man behind the session, Sanjay Bhai, of course, and who is going to briefly introduce both the speakers, Mr. Edson and our very own energetic Ekansh Bhai. So over to you, Sanjay Bhai.
Thank you, Mr. Secretary Ahmed, and thank you, Chairman, for your kind words. So the why we kept the playbooks, I think one of the reason behind is the Asia Cricket Cup season is on. So that was the logic behind why we kept it playbook. So I think Amit, you got an answer now. So to like in a cricket, we face that some kind of the bouncer. Like every tax amendment feel like a bouncer. Every FTA clarification is like a googly, and every compliance strategy needs to be a 6 over long on, and to stay ahead of the games. To help us to understand more about the intricacy of this, how to meet those challenges and send the success out of the park, we have two star players. First, Mr. Edson, he is the Associate Director, Customer International Trade Dubai, with over 17 years experience across the Middle East, Europe, and Mexico. The all-rounder of global trade compliance, leading multi-country custom project, advising governments, and guiding industry like automotive, energy, pharma, e-commerce on compliance, cost optimization, and digital transformation. Welcome, Mr. Edson. And our own superstar, second speaker is Mr. Ekansh Agrawal, a merit holder, chartered accountant with 10 plus experience in indirect taxes, tax tech, currently manager at KPMG UAE. The finisher you has advised more than 1,000 clients, 3,000 plus professionals on VAT and e-invoicing, and is known for turning complex tax topic into winning shot with his business first tax savvy approach. So get ready, this UAE indirect tax playbook. It will promising you, I mean, to learning strategy and big tax success. So over to you, Ansh, to take it forward and all the very best. Thank you.
Thank you, Sanjay ji. Hi, everyone. Good evening. I'm sure most of you, as Jayabhai mentioned, most of you must be wondering, uh, like why we are discussing about indirect taxes in the month of busiest month for corporate tax. But we'll try to make sure that towards the end of the session, you will get a quick refresher of what has happened in this year, in the past 6 months or so, when it comes to indirect taxes, which is VAT, excise, and customs. Because FTA is not just focused on corporate tax, we have seen considerable amendments, especially in the last year when it comes to VAT. So, without further ado, let me share my screen and we'll take this forward. I hope my screen is visible. Perfect. Great. So we'll be playing, or I would say we'll be juggling with indirect taxes today, which is VAT, excise, and customs. All three are a form of indirect taxes. We'll start with VAT first. So the agenda that we have for today from a VAT perspective is that we will be touching on the recent VAT amendments. And there have been updates that have been made by the FTA on the Imara tax portal. Some of them are very, very critical. We'll also be touching on the voluntary disclosure and penalty regime. Since this is the eighth year of VAT implementation, there have been a significant amount of audits and assessments completed by the FTA. So we'll be discussing how those have impacted businesses and during the assessment proceedings. I'll also be discussing some practical case studies and highlighting on the case enforcement cases happening by the FTA from a VAT perspective. And since this is the corporate tax filing period, I'll also be touching on how VAT can impact your year-end adjustments, and followed by an interactive Q&A. Before we move forward, since this is the eighth year of VAT implementation, I'd like to just throw some numbers at you. As you can see, there have been 66 guides issued just on VAT, 48 public clarifications, 35 general procedures, and 10 plus cabinet decisions, and 7 which are the legislative published by the FTA and the Ministry of Finance. So there is the plethora of information available on VAT, and as you can see on corporate tax side, you keep receiving decisions, clarifications on a daily basis, repealing one clarification or the other. Similar things are happening on a VAT side, and there have been a couple of public clarifications and cabinet decisions published in this year itself. So we'll give you a quick refresher of what those are. But before that, the talk of the buzzword when it comes to taxes after corporate tax is e-invoicing. And there have been amendments in the VAT law on account of e-invoicing. Now, what are those amendments? See, many people are not even aware that VAT law has been amended, and the new text has been already published on the FTA portal. So you all can go and access the English translation of the updated VAT law and executive regulations in line with the introduction of e-invoicing. So we'll not be discussing e-invoicing, but I wanted to make sure that you know that as part of the introduction of e-invoicing, all these definitions, the invoicing procedures, the input tax credit procedures, as well as the penalty provisions have been introduced, have been amended on account of e-invoicing. So going forward, an invoice will also include an electronic invoice depending on your phase. And in order to recover input tax credit, you need to retain an e-invoice, not just that PDF or physical invoice. You will need to mandatorily have an e-invoice to avail input tax credit. So just wanted to highlight that. The other key updates which I wanted to discuss is I'm sure most of you are aware that VAT executive regulations were overhauled last year, effective 15th of November 2025. Now, pursuant to those amendments, a very, very detailed, a very, very helpful, a very, very useful public clarification was published by the FTA earlier this year. Now, that public clarification was a game changer because people were waiting on most of the amendments that were made last year, clarifying, okay, what will be in scope of those amendments, what will be outside the scope of those amendments. So this public clarification was released earlier this year, touching on all of these amendments made in export of services, export of goods, international transportation, local logistics, medical insurance, simplified invoicing, fund management, crypto, hotel apartments, and input apportionment. Now, I'll not be discussing all of these amendments in detail because I'm pretty sure you broadly know what changes were made. I'll just touch upon the major highlights. So, exporter services. Now, you need to undergo one more additional condition that the services should not follow special place supply rule for you to qualify for zero rating. Export of goods before 15th of November. The key challenge for exporters was to obtain an exit certificate to claim refunds. Now, that requirement has been made optional. It's not a mandatory requirement. On international transportation, so if you were providing vessels to the likes of ADNOC for drilling, exploitation, for all these things, those cannot be zero rated anymore. You need to make sure that the vessel that you're providing on lease, they should be used for transportation, commercial transportation. Local logistics lag, if you're providing local logistic services, local transportation of goods, those are subject to VAT at 5%, even if that is part of an international lag. But if you are providing that locally, if you are not the main supplier, then you will need to charge VAT at 5%. Medical insurance, this was a very welcome move. From 15th of November, you are allowed to recover input tax credit on your dependents even in Dubai Emirate, which was previously only extended in Abu Dhabi because it was a mandatory obligation of Abu Dhabi. But now, across all Emirates, you are allowed to recover input tax credit on dependents, which is one spouse and three kids up to 18 years of age. Even on Emiratis top-up cover, if you are giving top-up cover to your Emirati employees, that also you now have the opportunity to recover input on. Simplified invoicing, they now businesses issuing invoices to other businesses uh, are not effectively allowed to issue simplified invoices if they are not issued on the same date of supply. So effectively, they want to eliminate the concept of simplified invoices for B2B supplies. So if you are prior to 15th of November, what businesses were doing, if the invoice value was up to 10,000 dirhams, they were not bothered about the customer name, customer address, and TRN mentioned on the invoice because it was a simplified invoice. But from 15th of November, you need to have all those fields, even if the value is below 10,000 dirhams, because you need to issue simplified invoice on the date of supply, which is normally not the case for B2B supplies. Exemptions were introduced for fund management services and crypto supplies. For crypto supplies, it went retrospective to 1 January 2018. Hotel apartments and input tax apportionment, there's some certain amendments were done, which I'll be discussing in subsequent slides. Coming on to the middle part, which is the centermost amendment, which is self-invoicing for import of services. Now, this topic, I'm pretty sure you would have seen plethora of LinkedIn posts. Every consultant in every firm has posted one LinkedIn update on this specific topic, whether I need to raise a self invoice for import of services. Now, I'm pretty sure if I would have done a poll, if I would have done a poll right now, there would have been divergent views on this point. Now, what is the verdict? So the verdict is three public clarifications were issued by the FTA back to back just on this point in this year. That means there were a lot of confusion on this specific point. Now the verdict is you don't need to issue a self invoice for import of services, provided you possess a corresponding invoice, a supporting invoice from the non-resident supplier of services, which many people were previously advising businesses. Okay, you need to obtain an admin exception if you are not issuing self invoices for import of services, but all of those opinions are invalid now. So you don't need to issue any self tax invoice nor obtain any admin exception for import of services if you have a valid supporting invoice mentioning all those relevant details, description, value, and everything from the non-resident supplier of services. In most cases, you will have some sort of document, right? Because you need to make payment to that non-resident supplier of service. So you will always have some sort of document, email, or any sort of acknowledgement which you can prove to account for VAT under the reverse charge mechanism. So, if you are still issuing tax invoices, self tax invoices for import of services, even when you have a supporting invoice from the non-resident supplier, then you may need to revisit those treatments. There was other certain other amendments, updates that were made earlier this year. One was on domestic reverse charge. It was extended to precious metals and stones. What is domestic reverse charge? I'm sure most of you know, just a quick refresher. So if you are supplying these items within UAE from a registered business to another registered business, the supplier does not need to account for VAT. The recipient will account for VAT under reverse charge mechanism. It's called domestic reverse charge. So it's pretty much applicable to gold. Gold also, if you're supplying gold which is not zero rated, domestic reverse charge applicable. Certain oil products, now these precious stone and metals. Other updates were on private clarification process has been revamped. Now, previously you were allowed to submit private clarification on behalf of other entities, but now you can't. Barter transactions, they have clarified what is the value to be used for barter transaction. It is the market value for the non-monetary consideration. Gold service charges, so they have clarified that until 31st December 2022, you can consider making charges as part of the domestic reverse charge scheme. But from 1st January 2023, gold businesses need to account for VAT. The supplier needs to account for VAT on making charges themselves. Crypto mining, they have clarified that crypto mining services are subject to VAT at 5%. This is very important when it comes to VAT, because there have been significant updates on the Imara tax portal and they keep undergo amendments, updates. So the amendments that have critically impacted businesses are on tax group registrations. Now, a lot of businesses at the time of implementation had included sole establishments in while making a tax group. Now, if you have any sole establishment in your tax group, you need to remove it because it is not required to be part of a tax group. Sole establishments are to be registered in the natural person they belong to. So, as Ekansh Agarwal, I can have four different sole establishments. For all those four sole establishments, Ekansh will register as Ekansh. So there's no need to form a tax group. So those sole establishments you have to remove and register as one under the natural person. If you are adding new members to the tax group, then previously you could directly add those new members to the tax group. Now the FTA is requesting a standalone registration first for those new members before being added to the tax group. And in most cases, the individual member that is being added to the tax group, sometimes they may have a retrospective registration obligation because they may have delayed applying for registration. So you cannot simply get added into the tax group and forget about your past compliances. So this is something which FTA is putting a leash on. And if there are any inactive members, I'm sure you would have a lot of tax groups within your organization which have holding companies which are not doing anything, no activity at all. Now, those holding companies or dormant companies, FTA is asking to remove them. So, if you have not already removed them, then you must look at your tax group and see what companies are inactive, not making any taxable supply, not incurring any expenses. Those will need to be removed from the tax group. Legal entity change. This is another important update that has been made in the recent times, where you, at the time of implementation, had mentioned an incorrect legal entity type when registering for VAT. So you could have mentioned other person or legal person incorporated instead of something else. Foreign businesses were registered as local legal person. So in order to avoid the deregistration and re-registration, FTA has now come up with the functionality to simply amend the legal entity type on the portal without you having to undergo the entire process of deregistration, because deregistration can take up to 1 year. So instead of going through the hassle of deregistration, re-registration, you can simply amend your legal entity type on the portal only if you're allowed to. You cannot use this functionality when your branch has been converted into an LLC. If your branch or your sole establishment has been converted into an LLC, that is not a legal entity change type. It is a change in the legal entity itself. So this option is only available where you selected a wrong legal entity type at the time of registration originally. Now you can amend, you can regularize it, but you cannot simply use the functionality when your branch is being converted into an LLC or a sole establishment has been converted into an LLC. Coming on to voluntary disclosures, I have a separate slide for that, but voluntary disclosures, we must know that now, even if there is zero tax impact on account of zero rated supplies or exempt supplies or emirate wise reporting, even in those cases, we are mandated to file a voluntary disclosure. It's not an option. We must file a voluntary disclosure. The other thing I would like to highlight on this slide, as you can see on the bottom, I mentioned separate taxable person accounts for VAT and CT. Every day or sorts, I receive a message that I have registered my company for CT in a different account, different taxable person account, and for VAT in a separate taxable person account. Now, how do I sort this? See, this is a very big issue. First of all, if we are a tax consultant, then we should never advise our clients to make two separate accounts. VAT, corporate tax, all taxes must be registered on the same taxable person account. If those have been registered, unfortunately by mistake, under separate taxable person accounts, then one account will need to be deactivated by deregistering, and then you will need to register again in one of the two accounts. So that's the only way to resolve this. I was seeing some messages on social media, on LinkedIn, that you can merge these accounts, but trust me, there is no concept of merging two accounts. You have to deregister unless FTA has given special and exceptional approval to some businesses, which I'm not aware of. But you cannot merge these accounts. You will have to deregister, and register in one of those two accounts. So if you do not do that, you may face issues in the future. You may, in the future, 2 years down the line, 3 years down the line, FTA can come back knocking on your door, and the consequences of you regularizing 2 years down the line, 3 years down the line will be far worse than if you do it today. Uh, any questions or?
No, you continue, please.
So we'll take the questions towards the end, right?
Yeah, the participant can write a question in the chat box.
Perfect. Great. The other thing I have seen a lot of us going wrong with voluntary disclosures. See, sometimes I ask questions, okay, when do I need to file a voluntary disclosure? When do I not need to file a voluntary disclosure? So I would like to clarify it in a very layman language. So this is the legal provision for submitting a voluntary disclosure. When do you need to submit a voluntary disclosure? When your payable tax is more than 10,000 dirhams, or when there is no difference in the amount of due tax. As tax professionals, we must understand what is the difference between payable tax and due tax. See, payable tax is what you pay to the tax authority as net tax after adjustment of output minus input. So that is the net tax that you pay to the FTA. That is called payable tax. So as part of your voluntary disclosure, if the net payable tax is less than 10,000 dirhams, is up to 10,000 dirhams, then you do not need to file a voluntary disclosure. But if it is more, then you must file a voluntary disclosure. Second, when you need to file a voluntary disclosure, when you have done an error and there is no difference in the amount of due tax. Basically, the error does not impact due tax. What is due tax? Tax that is calculated and imposed pursuant to this decree law. So if your error has not resulted in any impact on due tax, then also you need to file a voluntary disclosure. Now, a public clarification was released last year by the FTA, which clarified what are the errors which have no impact on due tax. And one of those errors they clarified was failing to report imported services. Now, a lot of questions arose. Okay, if I forgot to report, if I forgot to report any, reverse charge supplies, for import of services in my box 3 and box 10, do I need to file a voluntary disclosure? The answer is no. Even though FTA is saying you in this public clarification that failing to report imported services require you to file a voluntary disclosure, but the answer is no, because the FTA released another decision earlier this year where they again clarified. So the clarification highlighted in yellow above is repealed, and it has been replaced with this cabinet decision, FTA decision on the bottom, which is Article 2. So only in these three cases, I need to file a voluntary disclosure when there is no impact in due tax. So effectively, there are four cases where I need to file a voluntary disclosure. One is payable tax is more than 10,000 dirhams, and these three cases, one payable tax and three cases of no impact on due tax. So total four cases. No other case I need to file a voluntary disclosure. Now on this slide, I have mentioned multiple scenarios. Now these are exhaustive. I've covered pretty much all scenarios here. Incorrect reporting of zero rated or exempt supplies in a VAT return. Do I need to file a VD? The answer is yes. Reporting of, I don't know, someone messaging. Fine. Incorrect reporting of zero rated exempt supplies. See, these transactions do not have any impact on due tax. You need to file a VD. Reporting of 5% supplies in an incorrect emirate. Yes, this is one of the errors which does not have an impact on due tax. Yes, you need to file a VD. Incorrect reporting of an RCM transaction use of fully taxable supplies. The answer is yes or no. Its answer is no, because this has an impact on due tax because you calculate output tax as well as input tax, but the payable tax is zero because you you account for output tax, at the same time you account for input tax, so the net payable tax is zero, so you don't need to file a VD. Incorrect reporting of an RCM transaction used for exempt supplies. In this case, you may need to file a VD if the net payable tax is more than 10,000 dirhams. Because if you're using import of services for exempt supplies, then you cannot recover full input tax credit in box 10. Understatement of 5% supplies where VAT amount is AED, yes, because the net payable tax is more than 10,000, 11,000 dirhams. Omission of 5% supplies, if the VAT amount is 9,000, no. 5% supplies, so you have an output tax of 15,000, but at the same time, I have an input tax to report of 4,000. Here, I need to file a VD because net payable tax, which is 15 minus 4, is 11,000, which is more than 10,000. Now, in the next example, the net payable tax is less than 10,000, which is 15 minus 6, which is 9,000. So I don't need to file a VD. I can adjust it in the next tax return. Overstatement of 5% purchases where VAT amount is 11,000. So I have claimed excess input tax more than 10,000. Yes, because the net payable tax is more than 10,000. So I need to file a VD. If it is 9,000, then I don't need to file a VD. Overstatement of 5% supplies where the VAT amount is 11,000. Now I have reported excess VAT, excess output VAT. Do I need to file a VD? You don't need to mandatorily file a VD. It's an option. Because when you have paid excess, it's an option for you to reclaim it back. It's not a mandatory obligation on you. Similarly, but in both these cases, whether it's 11,000 or 9,000, the 10,000 dirham threshold is only for cases when you need to mandatorily file a VD. When you reported less than what is required, then the 10,000 threshold comes into picture. But when you paid excess, even if you paid 1 dirham extra, in order to reclaim it as an output VAT, you have an option to file a VD. Understatement of 5% purchases where the VAT amount is 9,000 dirhams. In this case, also, you forgot to report certain invoices, you forgot to claim input on certain invoices. In that case, the threshold of 10,000 dirham is not applicable. You always need to file a VD if you want to. It's an option. On this slide, I have mentioned the answers for each of these scenarios. So yeah, if you have any questions, put it on the chat box and we can take it up in the Q&A session. So this is on VD. Now we also need to compare when I file a VD, what are the penalties versus if I disclose everything correctly, what will be the penalties? So on this slide, you can see there is a tax period July to September 2024. And in that tax return, I disclosed, I have a VAT payable of 100,000 dirhams. Now, let's say I don't have 100,000 dirhams to pay. Okay, I don't have the amount to pay to the FTA. And I have not paid it until August 2025. So now what will happen? What will be the penalty? It is late payment penalty of 4% per month. So this is the penalty which is applicable if you don't pay the tax declared in the VAT return. So until August, for this return, it will be 10 times, 10 months. So 40% of 100,000, this is the amount of penalty you will pay if you decide to pay it in August end. Now, imagine if you had not declared anything in the return. You had declared zero amount in the return. And then you file a VD now. What will be the penalty? Penalty will be 5% of the tax amount. So which will be, because VD, if you file within first year, it is 5%. So is it like beneficial for me to not declare any tax in the tax return, rather just file a VD and be subject to lower amount of penalties than the amount of penalties I would have to pay if I declare and not pay? This is the case. This is the factual case, but we don't generally we don't advise clients, because this is sort of, you can say, tax avoidance or tax leakage, because you cannot simply not report anything, because as a business you are bound to report everything correctly in your VAT return. However, we have seen businesses taking these positions in the market, and some consultants have also advised their clients, okay, don't report anything in your returns and just file a VD. I know that you could save certain penalties by not declaring in your original return and just simply filing a VD. But if FTA, catches hold of that, you could end up in other penal provisions on account of tax avoidance. Tax may not be a tax evasion, but they could impose certain harsh provisions on you. Lastly, if you don't do anything, you don't declare, you don't file a VD, then you get audited, then the penalties are much more, because then you have a 50% amount of the error, which is fixed penalty during audit, plus 4% per month, plus 2,000 for incorrect filing of tax return. So this is the just to give you an overview how penalties are calculated in three scenarios. One is you file a VD. Once you file the return correctly and not pay the tax. Second, you don't declare anything but file a VD. Third is you don't do anything and you get audited. Now I'll walk you through some of these case studies which we have seen practically in the last 7 to 8 years. Normally, before going to the case studies, when a tax audit is triggered, typically from a VAT perspective, so the FTA typically triggers an audit in these automatically in these three cases. Uh, so if your company has not applied for VAT refunds for the years 2018, 2019, and 2020, the system is automatically triggering an audit at the end of 5 years. They will issue an audit notification, and which will make the FTA be eligible to conduct an audit for 4 more years. So you need to check if you have not applied for refunds for these years, then you must revisit and apply. Either apply for refunds, file VDs if those refunds are not eligible. Also, in VAT deregistration request, if you're filing a deregistration request, then they will conduct a mini audit of sorts of all the last 5 years. And if they find anything, invalid or suspicious, they might ask you to file VD and, disallow. I've seen literally cases where a company was deregistering for VAT and they had not reported a single amount of sales in the last whatever amount of years they were operating, and they had claimed input in those returns. FTA simply denied all the input on the basis they said you have not reported a single amount of sale, and whatever refund you got, you have to pay it back before you get the deregistration approval. So this is another case where you will go through deregistration of audit by the FTA. The last one is fictitious adjustments. Now, what are fictitious adjustments? I will cover in this case. Most of us are not aware of how actually during audits how FTA imposes penalties. So this example will give you clarity on how FTA imposes penalty. So on this slide, you can see this example where I have 4 tax periods. Tax period number one, which is July to September, I have a VAT payable of 100,000 dirhams. Now, that VAT I did not pay, I did not have cash to pay. So late payment penalties were accumulating on the amount. So imagine on 100,000, 36,000 was imposed until now, and total payable is 136. Similarly, for October, December, I again had a VAT payable of 200,000 dirhams, which resulted into 48,000 dirham of late payment penalty, and total became 248 plus 136. Third tax period, I again had a VAT payable of 300,000 and I could not pay it. 36,000 dirham of late payment penalties were imposed, and total payable uh, as on end of March 2025 return is 720,000 dirhams. Now, this is a real case. This is actually a real case which I dealt with recently. Now, what happened in this case? There was a genuine company who had, imagine, a payable of 720,000 dirhams as at end of March 2025. Now, they still didn't have cash. Now, one consultant, what they advised to this business, they they advise to report in April to June 2025 a negative adjustment in box 9 for 720,000 dirhams, exact to the amount of payable before that date. Now, this box 9 adjustment of the amount of 720,000 dirham effectively nullified everything, all the liabilities before that date. Because as you know, if you have refundable or receivable in a future return, that will adjust all your past liabilities. So effectively, this 720,000 dirhams without any supporting invoice, without any eligible credit, this effectively adjusted everything, and the penalties became everything. I mean, the owners were dancing in the sky and everything because their liability became zero. Now, how did it pick up? Now, this was audited. Normally you don't get audited, right? There are like almost 500,000 companies registered for VAT in the UAE. FTA cannot go and audit each and every one. Now, how did this company came into the audit scanner? So FTA was noticing the trends. Okay, how this they had payable, they had late payment penalty. So they have some algorithm picked up in their system. So they were doing some trend analysis, and they noticed that in this particular period, they have this amount of receivable which is as equivalent to what was payable until that date, and which effectively made everything zero. So they audited this taxpayer. They sat on their premises for 3 months, and after the audit was concluded, they found this 720,000 dirham adjustment is completely bogus. It has no basis. Now, what are the implications? Now, sometimes when I ask my client, okay, or anyone for that matter, now FTA has audited each and every tax period from July 2024 to June 2025. Is there something wrong in July to September 2024? Will FTA do any assessment there? The answer is no. October to December 2024, answer is no. January to March 2025, answer is no. These three tax periods are completely fine. There is no assessment done on these three tax periods. FTA will simply focus on the last tax period where you have claimed undue adjustment, fictitious adjustment of 720,000 dirhams. Because everything that was reported in the previous three tax periods was correct. I'm assuming everything sales and purchases were correct, but they will not go back and reopen those assessments. Just because you claimed an undue adjustment in April to June, it effectively, whatever it adjusted before that date, this is all done and dusted. They simply focused on April to June. They added 720,000 dirham as liability, first of all, then 50%, which is a fixed amount of penalty on the amount of error, that led to total 1.08 million dirham of liability. Now, most of you must be wondering, in this scenario, has there been a penalty on penalty? Because 720,000 dirham includes penalties of 36,000 dirham, 48,000 dirham, 36,000 dirham levied in each of those tax periods. And again, there is a 50% penalty on 720,000 dirham, which already includes penalties. Yes, there is a penalty on penalty, but this is genuine. You cannot challenge this because as soon as you claimed incorrect input of 720,000 dirham, it became tax amount. So it changed the nature into a tax amount. So everything that was there until now, so 720,000 dirham took the shape of a tax amount. And now, since it is a tax amount, FTA can impose more penalties on that tax amount. So I know we can chat during Q&A if you have any questions. Similarly, I'm sure most of you must be wondering. Most of you would have seen this case. I'll just quickly run through this case. Now, some sectors, especially scrap sector, you are seeing that refunds are being denied to businesses. So, exporter of scrap metals, they are not getting refunds from the FTA. The reason is why? Because D is the exporter of scrap metal and claiming refund from the FTA. But FTA is denying VAT refunds to D because A, who is the first party in the supply chain, never paid the VAT to the FTA. So these people, so D was claiming refund for the last 5 years, without any issues. But FTA in the last few years noticed that to this particular industry, they have been giving billions of dirhams of refunds. But from this industry, we are not getting any VAT, output VAT. The output VAT should effectively come from A, because B is first, taking input of A and adjusting their output VAT. Similarly, C is taking input on B's invoice and adjusting their output VAT. D is not having any output VAT because they are exporting. So they were effectively claiming VAT refunds for an amount which was never paid by A. So this is a chain where VAT refunds are being denied. Uh, Most of these sectors which were following this supply chain, they were kept under domestic reverse charge category by FTA. Initially started with gold, and then electronic devices. Now it's happening to scrap metals. So we are expecting that for scrap businesses also we may have, I mean, expectation, I'm not giving any announcement, but expectation is that we may see a domestic reverse charge scheme for scrap metals, so that there is no VAT on supply from A to B. It will just be a self accounting of VAT by B in its VAT return. Similarly, C will record a domestic reverse charge, input output. And similarly, D will record input output. So effectively, FTA is not giving any cash refunds to D, to the exporters. So even though D has all the required documents, D has paid VAT to C, still they are being denied refunds by the FTA, because in the entire chain they never got VAT from the first supplier. Now, retrospective VAT registrations, I'll quickly run through this. Now, there are a lot of businesses which did not register previously, and now realizing that they were supposed to register. And so how long can the FTA go back? Can they go back only 5 years, or can they go back uh, all the way back to 1 January 2018? The answer is all the way back to 1 January 2018, because the statute of limitation for retrospective VAT registration is not 5 years, it's 15 years. So even if you were supposed to register from 1 January 2018, and if you are applying now, you will be registered from 1 January 2018, not 5 years ago. So in this example, if this company applied for VAT registration in July 2025, but was supposed to register from January 2018, they will be registered from January 2018 and will be subject to late registration penalties, late filing of VAT returns, plus late payments of VAT. So this is so retrospective registration, where I am seeing personally are most cases where non-registered businesses, non-resident businesses, they are making supplies to end customers in the UAE, which is typically of electronic services in the UAE. Now, similar to voluntary disclosure scheme, can the company report nil returns for the past and then file VDs? Of course, I will not advise that. You still need to populate all those VAT returns from January 2018 when you get registered until today, and then settle all the VAT liability. Of course, you will be subject to late payment penalties of 4% per month. Now, one other creative idea I get from clients: okay, can I decide to report, not to report anything to the FDA and register prospectively? So this is considered as a tax evasion. This is a clear case of tax evasion. I have literally seen a lot of companies not disclosing the details of their sales made in the last 5 years. So when you are registering for VAT, I'm sure most of you know, you need to give a turnover declaration letter. You are declaring to the FTA that these are the sales made in the last 5 years, all the way back from 1 January 2018. Now, to avoid late registration penalties, late payment penalties, people are saying they had zero sales in the last 5 years. Now, due to corporate tax, now you cannot hide anymore. If you declare something in corporate tax and not in VAT, you're going to be caught, and this is going to result into significant tax evasion provisions. So this case study is on VAT grouping. now a lot of companies, as I started earlier, that you cannot simply add any company in a VAT group. You need to make sure those companies have a valid business activities. So if you only have companies, holding companies earning passive income like dividend income or interest income, then those effectively are not eligible to be part of the tax group. So just on that, if you have any such companies, you need to revisit, because FTA will definitely ask them to remove it sooner than later. So this is on that. On the enforcement, literally, I have personally seen multifold increase in VAT cases. The law firms are really busy with VAT cases, as you can see on the screen. How it We have seen literally fivefold increase in court enforcement applications. As you know, the first step is if you have received an audit assessment, you first request for review of that tax assessment, then you go for reconsideration, then TDRC, and then courts. So, given we are in the 8th year of implementation, and there have been a lot of cases where the taxpayers are not agreeing with the FTA on many issues. One such issue I'll be discussing shortly. Uh, so before going to input taxes portion, I'll discuss this case. Now that we are completing audits, now that we are finalizing our accounts, this was a case for one of the largest real estate companies in the UAE. They were issued uh, this significant amount of assessment by the FTA, and they fought at the reason I can disclose the figures because it's a public listed entity, and the figures are in public. So we were the auditors, and they asked us, are we properly provisioning VAT in their books? So FTA denied zero rating on serviced apartments which this developer was supplying. Made them subject to VAT at 5%. So all the way back from 2018, January 2018, and it led to billions of dirhams of penalties and tax amount. Not millions, it's a billion with a B. And this developer fought until the last stage, and unfortunately they lost. They had to pay everything, and to that end they made an amendment to executive regulations last year effective 15th of November, that serviced apartments, not just serviced apartments, if you have a hotel apartment, those are subject to VAT at 5%. Those you cannot bring at par with residential. You cannot say these are residential use. So in this context, I always tell to my audit colleagues, audit friends, that we must consider VAT as part of year-end provisions, because there are many cases. I literally had a client who was not accounting for VAT on certain recharges made to group companies. And when I did the health check, due diligence, a significant amount of VAT was payable along with penalties, and that amount had to be provided for in the accounts. So we had to create that provision as an auditor, as a is my duty to correctly account for VAT and see if this was not accounted, then I need to provide for it in my accounts. So not just on these charges, everything, employee deductions, incorrect recovery of input tax credit. So as an auditor, it is my duty also to ensure that maybe get a health check done. Maybe if the amounts are material enough, if the VAT is material, maybe $100,000 or whatever is the materiality for that group, we need to consider some sort of external review to assess if everything what is being done. Because tomorrow, if FTA comes knocking after 5 years, the amount of liabilities will be much larger. And if we have nothing to provide for in our company, then that year can be your last year in the UAE. I've literally seen companies getting shut because they were applying VAT at 0% for something that was 5 for the last 5 years, or and it's on your top line. We must not discount VAT because it's just indirect tax. It is a tax on your top line, and corporate tax is only on your profits. So VAT has the power to. I literally saw that company got liquidated because they could not pay the amount of VAT and penalties. Input tax apportionment, I'll quickly summarize. I know most of you, there were a lot of confusions when it comes to input tax apportionment. Uh, how should I, are there any changes in input tax apportionment rules? Some consultants, even some big fours advise their businesses, okay, yeah, you need to amend this, okay, include everything in the ratio and everything. Bottom line, there are no changes in input tax apportionment rules. You follow what you were doing before. You continue to do the same. So no changes in input tax apportionment rules for for doing the exempt transactions. Now, lastly, on transfer pricing adjustments. Now, since most of you are doing benchmarking studies for last year, so if you have any transfer pricing adjustments, you must make sure that you are correctly adjusting them from a VAT perspective as well. Whether you need to issue a debit note, new tax invoice, credit notes, file voluntary disclosures. From a custom side, if they relate to goods, Edson will be touching on that. So this is also crucial. So as tax consultants, as advisors, if we are seeing any transfer pricing adjustments, then we must highlight that this may have a corresponding impact in your VAT returns for the past. Now, some of the common myths and mistakes on the slide that refunds and audits cannot happen after 5 years. It can still go up to 9 years. Input tax credit cannot be recovered after two tax period. This is wrong. If I have an invoice dated in 2018, if I receive it today, I can still claim it now. So I have to look at the date I received the invoice and I form the intention to pay. Capital asset scheme is not applicable to taxpayers. It's only applicable to taxpayers that are making exempt supplies. VAT return is based on invoice dates. It's incorrect. It's based on date of supply. So even if you have an invoice dated, let's say today, 11th of September, but the date of supply was in August, you will have to report it in the August month VAT return. But most companies simply filter through the invoice date and prepare their VAT return. So this is also important to understand. As I mentioned, recharges, employee salary deduction, these are all subject to VAT. And there is a difference between out of scope, exempt, and zero rated supply. So these are some common myths and mistakes. This is the last slide. And future of VAT, what can we expect in the future? We have already seen two VAT rate changes in the GCC. Saudi increased VAT rate from 5 to 15% in 2020 during COVID time. Bahrain increased from 5 to 10%. Oman is still at 5%. So this is something that we can expect. The rate may not be 5 years down the line. It may become 10 or 15 or whatever, we don't know. E-invoicing is on the cards, which is going live next year, July 2026. We had a session, ICI had a session last month on this implementation. Now, since CT has been implemented, and I mentioned about provisions, so there will be reconciliation by the FTA between CT returns as well as VAT returns, and this may trigger audits. And as I mentioned, VAT rate may be aligned with the GC countries, but for now, the implementing state criteria is on hold. So every other GCC country is as equivalent to any part outside the UAE. That's from me. Thanks. Thank you so much. I hope this was useful.
Thank you, Ekansh.
I know I exceeded.
The questions we will take at the end of the session. Sanjay bhai, you can please guide. So I think let's go to the next speaker, Mr. Edson.
Sure.
All right.
Okay.
Edson, should I go to the next slide?
Yes.
Yes. Thank you. All right. Thanks, Akansh. Yeah, before starting, from a let's say the customs standpoint, I would like to mention something quite important, right, for you to have a sort of a perspective. So I suppose everybody is, or most of us are in the UAE, right? So in the UAE, certainly there is a customs authority, right, at federal level for the seven emirates. But nonetheless, each emirate has its own customs authority, right? And even when we are talking about the same, let's say, customs regulations that are based on the GCC Common Customs Law,
each customs authority of each emirate regulates and applies in practice from a different way, right? So you need to, let's say, cope with that complexity of having, for example, to deal with Dubai customs if your company is located in Dubai, or Sharjah customs if your company is located in Sharjah, or Abu Dhabi customs if your company is located in Abu Dhabi. So that's the complexity essentially from a customs point of view, right? Now, having said that, I will take you through some recent changes, right, in the UAE from a customs perspective. Uh, Most of them are obviously applicable at UAE level, but mostly I will refer to Dubai customs or Dubai, where is let's say the emirate where most of the companies are located, and also possibly Abu Dhabi. So the first point that I would like to highlight here for you to consider is the licenses, right? So for you to know any company that imports or exports in the UAE requires a customs code, okay? And that customs code should be obtained from the customs authority where the company is located, right? So let's say that the company is located in Abu Dhabi, so it should get customs code from Abu Dhabi customs. Even if the company is located in Abu Dhabi, and if it intends to do imports or exports in Dubai, it should obtain an additional customs code in Dubai. So just in recent times, we have seen that mostly Abu Dhabi and Dubai customs are looking closely to the licenses, right? So as you know, your customs code is linked with your license, trading license or industrial license, whatever the case may be. And then if your customs code, let's say, is linked with your license, then as long as your license is valid, your customs code should be valid as well. But nonetheless, for giving new customs codes and for renewal of current customs codes, the customs authorities are looking at the activities that are mentioned in the license, right? So in summary, if your license doesn't have any trading activity or import-export activity, your customs code may be rejected as a first application or rejected in a renewal process, okay? We have seen lately that many companies in the past were allowed to do imports even when the activities in their licenses were not related with trading or import and export activities. And now this change in the criterion has been causing some disruptions to the company. So this is just a highlight here for you to consider, right? So you need to make sure that all your activities are aligned for new customs codes, new licenses, or existing licenses for renewal processes. Some other recent changes here. As you may know, well, from January 1st, 2025, right, the GCC countries actually implemented what is called the GCC Integrated Customs Tariff, okay? So, which means that instead of using 8-digit level tariff classification codes, now it is expanded to 12-digit level, okay? Saudi Arabia actually was the only country in the GCC who used to have a 12-digit HS code, okay, tariff codes that just for you to know, a tariff code or tariff classification is an international harmonized code that is allocated to each product, right, tangible good, from the natural or agricultural kind of way of products of to more sophisticated and technological products. So each product has its own tariff code, And based on this tariff code, the customs authorities allocate the applicable import duty, right? All the non-tariff barriers. That is, for example, import permits, licensing, and so on. So the call out here with the GCC integrated customs tariff is that you should look into your classifications, right? And especially for the UAE, just recently the customs authority, especially in Dubai, has announced that it will have a progressive implementation, right? Because ironically, from all the GCC countries, the UAE is the only GCC state that is pending to fully implement the 12-digit level system. So it will be phased, right? First, will be applicable for all the transactions within the GCC countries, and then subsequently will be implemented with transactions with the rest of the world. All right. Now, another important update here is the CPAs, right? That the UAE is undertaking with several nations. So the CPAs are essentially the abbreviation means the Comprehensive Economic Partnership Agreements, right? But in simple words, are free trade agreements, but with some with kind of a limited scope. Okay, as you know, the UAE is member of the GCC countries. The GCC countries have a customs union, which means that they share a common customs duty to third-party countries, right? And in principle, the flows between GCC are not subject to customs duties. Now, the GCC countries as a customs union or as a bloc, they have free trade agreement with Singapore and the European Free Trade Agreement Association, right? Countries that is were essentially composed by Switzerland, Norway, Iceland, and Liechtenstein. However, it's been quite difficult to align the GCC countries as a bloc in order to undertake a free trade agreement. So what essentially the UAE has done, it's undertaking or celebrating bilateral free trade agreements or bilateral CPAs with many countries. So far, there are 27 countries on the agenda. Some of them to mention, India, Israel, Indonesia, Turkey, Cambodia, Georgia, Costa Rica, Mauritius, Serbia, and most recently, Jordan and New Zealand, right? With these countries, the CPAs or the free trade agreements are in place, and for the others are in the pipeline. So just to highlight here, the UAE and India have this CPA, and let's say in a nutshell, they have agreed to have a free trade agreement of flows of certain goods, right? To be mutually beneficial and increase the transactions flows between the two countries. Okay. Now, another recent update that I'm sure most of you or most of us are aware of, right? Because media is on the media, is everywhere. And maybe you may have found some disruptions in your supply chain, are these reciprocal tariffs, right? Imposed by the Trump administration. So these tariffs are affecting all countries around the globe, right? Are set up country-wise, and you know better than me that recently this reciprocal tariff for India has been increased, right, by 25%, and some cases may top up to 50%. So in these cases, companies obviously need to look at their supply chains, see which options do they have, right, in order to avoid, well, most importantly, disruptions, and see how the customs duty could be streamlined, right? maybe by using alternative mechanisms such as the CPAs, right? Having let's say an alternative market or point of manufacturing hub in the UAE potentially, right? So these are the main let's say hot topics updates that we have here recently. If we can move on to the next slide, please. Okay, so here let's discuss some common pitfalls between VAT and customs, right? And how they interact. Because we may think that customs is an isolated area, right? That only matters when you need to bring some urgent part, right? Or machinery, and then it's when we look at the customs guys. But definitely customs is an indirect tax, and it has a lot of relation and is interconnected with VAT, and most recently with the corporate tax and transfer pricing as well, right? So just to give you an example here, for example, the first point is in terms of imports, right? The customs value on imports. You may have heard that in this urgency, right, for bringing goods, sometimes the tax invoice is not ready, right? If you do a purchase, right, of any certain raw material or machinery and equipment from abroad, and then it's super urgent, whatever it takes to bring the machinery or the goods to be imported, you will do it, right? So luckily, from a customs perspective, the goods or the importation can be made just with a pro forma invoice, right? With that customs value included, or the one value included in the pro forma invoice. But that definitely is not the tax invoice, or the last or the invoice that we consider for tax purposes or for accounting purposes, right? So then that's the first pitfall, that sometimes companies are bringing or importing goods, right? And just for the urgency, they just bring the goods, they prepare the logistics or the customs teams just prepare some pro forma invoices, right? They allocate one value, maybe is not the final value, or maybe it's not the base price or the price paid, right, for the good. And then in customs is register one good, right, or one value, and then for accounting and tax purposes, 2 days ago, or sorry, 2 days after, or 1 week after, whenever the tax invoice is ready, now let's say the tax value or the accounting value is registered, right? So there is a mismatch there. That's why the reconciliation between import information held by customs authorities is quite important for VAT purposes, okay? Another example here is the ownership aspect, okay? Just to give you this example, you may imagine that you have a company in mainland, right? And it performs an import for free circulation, which means that it will pay import VAT and import duty, okay? 5% each. So from a customs perspective, the importer of record in mainland UAE may or may not be the owner of the goods, right? And this is perfectly fine for customs purposes. But nonetheless, for VAT purposes, the importer of record typically should be the owner of the goods. Otherwise, there could be some challenges to recover the import VAT, right? And then unless there is another, let's say, formalities that should be met when the importation is carried out by an agent, right, or a third party. But this is one of the main pitfalls that possibly companies are not aware of, and then they ignore, right? That even from a customs perspective, it's feasible to import any good without being actually the owner. Nonetheless, it may cause some challenges from a VAT perspective. Now, we have another important topic here, that is the proof of export, right? For 0% VAT rating application. Okay. So Kanch mentioned there that one recent change actually in the VAT regulations applicable since 15 November 2024 was the expansion of this definition, right? The proof of export. So in the past, normally, usually, right, the official evidence was the exit certificate, okay, obtained from the customs authorities, let's say Dubai Customs or Abu Dhabi Customs, okay. The tax authority, FTA, was asking for these exit certificates even when for refund purposes, right? VAT refund purposes to support the exportation of goods. And the exit certificates, just for you to know, to ask them in a retrospectively, is quite difficult, okay? And here also we have this mismatch in terms of Abu Dhabi Customs has an automation process online to request for the exit certificates, but nonetheless, Dubai Customs has a very manual process, right? And every time that you require, let's say, exit certificates from the past, it's quite difficult, almost impossible, okay? So it seems that the FTA has noticed that, and also hearing the voice from the industrial community, and then this definition has been expanded, right? So now, not only in order to prove the export for zero VAT purposes, there are two options, right? Generally speaking, the first one is providing the customs declaration for export plus the commercial evidence, okay? Meaning commercial evidence such as a bill of lading, a bill, a manifest for land or for any other mean of transport, okay? Or alternatively, let's say the shipping, this is a new concept, the shipping certificate and the official evidence, right? Or plus the official evidence. So meaning a shipping certificate is a certificate issued by the transportation company in absence of bill of lading, or bill and manifest, right? This is a new concept. Maybe some carriers may not be familiar with it, but nonetheless, it is there as an option, and also the official evidence, that is essentially the exit certificates issued by customs authority in the export country, let's say of the UAE, let's say Dubai or Abu Dhabi Customs, or the entry certificate in the country of destination. So as you can see here, this is another point where actually VAT and customs interact, right? And there are common pitfalls to think that only with the exit certificate it is taken as a valid proof for export, but that is no longer the case, okay? Another point that I would like to mention here as a common pitfall is essentially sales based on ex works Incoterm, right? So as you know, a sale based on an ex work Incoterm means that the seller, let's say that is located in UAE mainland, and the buyer that is located abroad, agreed that the goods will be delivered just in the warehouse of the seller, right? So essentially, the seller just opened the doors of the warehouse, and the buyer goes, collect the goods, and is in charge of do all the export process, right? So here there is a complexity for you to know, because I'm probably some of you may have faced this situation, that in cases where the seller is not the exporter, right, and it, let's say, gives this responsibility to the buyer, that is a foreign entity, right? Essentially, the seller still need to collect all the evidence of proof of export, right? The evidence that I just mentioned before, okay? Customs declarations, commercial evidence, or shipping certificate, or other official evidence, okay? Sometimes, definitely, when the seller didn't hire the customs broker, didn't hire the transportation company that takes the goods abroad for export, and didn't hire any of the stockholders needed to export the goods, definitely tomorrow, in case an audit from an FTA, if the seller is not able to provide all this documentation, right, the 0% VAT rate may be rejected, okay? And then the seller will turn to the buyer and say, I need all these documents, right? Custom declaration, et cetera, et cetera. And what if those operations were made 4 years ago? Okay. And all the people in the buyer side or in the seller side are different, right? So all these complications may provoke that in the end, the 0% evidence, or the proof of evidence of export evidence in an indirect export, that is essentially an export operation, it would be quite challenging. Okay, so just wanted to highlight that for you to know, and just to consider that there are probably other alternatives, let's say other use of Incoterm or terms of sale, whereby the exporter actually is the exporter of record, and then it ensures that it will have access to all these documentations to support the 0% VAT. Okay, perfect. So let's go to the next slide. Right. So here I wanted to tell you some key considerations for free zone companies, right? As you know, across the UAE, the free zone companies, and most importantly in Dubai, and most recently Abu Dhabi, are one of the main players for import and export, and not only import and export, but also for the industrial and the movement of goods and services. Okay, there are more than 45 free zones in Dubai, so you may just imagine that. So here I wanted to just highlight some key aspects where, again, VAT and customs interact, and they may have different approaches for the same operation, okay? And that brings another level of complexity where the companies and the tax teams need to look at in order to support and justify any treatment from VAT and customs purposes. Just for the first column, the concept of designated zone versus free zone, okay? Just to start, as you know, from a VAT perspective, designated zone is essentially a free zone that has control, access, right? That has security, that individuals and goods cannot freely come in and out, right? Such as JAFSA, DAFSA, and just to mention a few, right? But nonetheless, for customs purposes, there are two types of free zones. Well, let's say that the free zones is a free zone is a single concept, but in practice, there are two types, right? Fence-free zones such as JAFSA, right? Such as DAFSA, okay? And there are also unfence-free zones such as DMCC, Silicon Oasis, Internet City, the IIFC, right? Where the free zone is just a building and people can come in and come out. So I'm actually seated in a free zone or next to a free zone, right? In the next building is the free zone, and I can just go and access, right? If I work there. So, but the complexity here is that from a VAT perspective, only that sort of free zones that are fenced, protected with a control access are considered as a designated zone. So which means that I jump to the next point that is for, let's say, customs duty suspension, okay? From a VAT perspective, there are some specific concepts or situations where the VAT is suspended, right? And it definitely follows customs regulations, okay? So all these customs procedures, temporary admission, customs warehouse, or introduction into customs warehouse, uh, transit, import for re-export, and designated zone are considered as suspension, right? Or are considered that the goods are not imported into mainland, right? Just to mention here the importance that from a VAT perspective, goods introduced in designated zone should be goods imported from abroad, right? From a country overseas, right? However, from a customs perspective, we do have the same or similar cases for customs duty suspension, that is temporary admission, introduction of goods into customs warehouses, transit, import for re-export, but we have got also the free zones, okay? And now the complexity comes here whereby for customs duty suspension, in terms of VAT, it's clear that it refers only to designated zones such as JAFSA, DAFSA, right? Or the introduction of goods from abroad to those designated zones. But nonetheless, from a customs perspective, the introduction of goods from abroad or overseas by a company that is located in the MCC, Dubai, the Internet City, as long as it has customs code, Silicon Oasis, right? That is on fence-free zone. From a customs perspective, it also counts as customs suspension, right? Which means that you may have a case of a company in the MCC that imports some equipment for testing, right? Into the free zone, the MCC, okay? And for customs purposes, the customs duty is suspended. But in strict sense, from a VAT perspective, since this is not a designated zone because there is the MCC, right? That importation of goods is not considered to be a customs duty suspension. And then the question here is how companies are dealing with this, right? We have got another situation here that, again, VAT and customs are interconnected, but they have a different approach here. For example, exports from local to free zones, right? If you have a company located in mainland, UAE mainland, selling goods, tangible goods, to a company that is in a free zone, from a VAT perspective, that is a taxable supply because it's considered to be made in the state, right? But nonetheless, from a customs perspective, exactly the same operation, sale of goods from a mainland company to a company that is located in a free zone, okay, is considered as an export, okay? And then there is no customs duty, obviously, on export, but once the goods are sell to a free zone company, the goods are considered to be out of the customs territory of the UAE, which means that once the goods that are subtracted again from the free zone are considered as a foreign goods, even when they contain local goods or goods that previously paid customs duties, right? So that's another complexity here, whereby the same operation has a different connotation from VAT and customs perspective, right? The last consideration here, also relevant for free zone companies, are supply of goods within the designated zone, right? As you know, from a VAT perspective, the taxable supply follows the rules of consumptions, all right? Let's say that if the goods, generally speaking, if the goods are consumed within the free zone, are taxable, right? With some exceptions there. However, from a customs perspective, the goods imported into the free zone and consumed within the free zone, right, should be reported to Dubai Customs to define whether they are dutiable or exempted. So, which means that essentially, let's say goods imported or introduced into the free zone from a local company, they enter again in the customs suspension regime. And if they are consumed in the free zone, they likely may be subject to pay customs duties unless they are used for the company operation. Okay, so this is obviously a bit more complex and it has more formalities to follow, but in the end, overall, this is another example of different approaches and different treatments for the same operation. Okay, let's go to the next slide, please. I think questions will be taken at the end. I will wrap up with this slide. So in terms of customs audits, okay, what to expect and how you stay prepared here. So the first thing that you should keep in mind is that a customs audit has different approaches depending on where the company is located, right? If the company is located in mainland, it means that if it imports some goods from abroad, it will be subject to pay import duties, right, for free circulation, okay? Let's say any retailer that imports goods for us, right, for individuals that go to the shop and consume any goods, all these companies will be subject to pay import duties, right? So then automatically customs valuation becomes relevant for them, okay? And then tariff classification becomes relevant for them as well because they may be, let's say, they may be subject to use a different or not subject, but for any mistake, they use a wrong tariff classification that contains 0% of customs duty. But the criteria of the customs authority is that it should be classified in a different tariff classification, HTS tariff classification that is subject to 5%. Then there will be an omission there, right? And obviously, fines and penalties will be imposed for that omission in terms of customs duties, right? And then as well, origin becomes relevant for let's say the tariff classification and also the imposition of non-tariff barriers, because let's say that some goods may be subject to countervailing duties or anti-dumping duties, and if they are not properly classified, right, they may avoid fraudulently that measure, right? Now, the customs audit may have a different connotation and a different focus if the company is located in free zone, Okay. A free zone company, as we mentioned before, assuming that it imports goods under a customs duty suspension, which means that the customs duties are suspended as long as they are in the free zone, or if they are transferred to a different free zone or designated zone, they may remain in customs suspension, right? But nonetheless, all those inbound and outbound movements should be justified to Dubai customs, okay? And that's why the reconciliation of inbound and outbound operations is hard. Companies in both fence and on-fence free zones may be cocked, right? Because they feel that, okay, Dubai Customs has never come to knock my door. I have 5 years, uh, all my records, but when the time comes, right, it's ironically that it's quite difficult to support imports and exports. All right. Um, and just to mention, the statute of limitation of free zone companies is from inception. It's not 5 years, right? Which brings a level of let's say difficulty here, right, for all the free zone companies, along with the inventory control system. I will just wrap up here with a proactive measure, that is the voluntary disclosure, right, for customs purposes. This is relatively new. It was introduced in 2024, right? And just for you to know that this is different for the voluntary disclosure for VAT purposes. It is not submitted through MRA tax. It is submitted through Dubai Trade, but in short, it has let's say, it gives the possibility of companies to self-declare, right, inadvertent errors or violations committed in customs declarations and avoid the payment of and imposition of fines, right, and penalties. So that's it from my side. Kansh, I will hand over to you, my friend.
Thank you, Madison. So I think few key takeaways from Edson's session is that a free zone concept this is different from VAT perspective and from a customs perspective. So you may have certain free zones where if you bring the goods, you will not have to pay customs, but you will still need to pay VAT. So that is the discrepancy. The other thing is on the exit certificates. You may still need to provide for those exit certificates for the period until 15th of November to get those, refunds from exports. And it's pretty challenging to obtain them on a retrospective basis. Lastly, if you have any corrections for customs, there is a voluntary disclosure mechanism for customs perspective as well. Sanjay ji, should we take up questions now or move to excise? What do you think?
Let's take us some few questions, and then with the end, I think we can take a question. Exercise.
Jay bhai, you are on mute if you are
Okay,
Yes,
speaking.
yes, hi.
Jay bhai, we can take up a lot of questions already.
Sanjay bhai, yeah, you can take over the questions, please.
Then we will take it. Perfect. Thank you. Okay, I can see Anish bhai. Oh, Anish bhai is here. So let me bring you on the screen and you ask your question yourself, sir. Please go ahead. Okay, no problem. You can go unmute and ask your question, please. The question is, I guess he's there. Anish bhai, go
Yeah,
ahead.
hi. Can a foreign company stock goods in Jabza in warehouse of group company and export from there? And bill of entry can be done by UAE-based group company. Is it possible?
I think this question is for Edson. Edson,
Yeah, well, the company in JAVSA has a license and a customs code, right? So
Right.
it's different from any other sister company or company within the group. Okay.
No, this is different.
Okay, perfect. If it is a different company, even if both companies are within JAVSA, let's say from a customs perspective, there are separate entities, separate customs codes, and if one entity transferred the goods to a sister company in JAVSA and then carries out the export, there should be a customs formality here, a customs declaration to transfer from one company to another company. So it's not like a VAT group treatment, right? That it's seen as a single entity. Now, from a customs perspective, each entity its own customs code, its own let's say obligations.
Okay, thank you.
Thank you, Anish. Next question, Sushil ji, please go ahead with your question.
Yeah, see, the company is based in the mainland, but it has a warehousing agreement with the Jafza based. So the goods are never taken out to the mainland, and the goods are delivered to another buyer who's based in Jafza for export, obviously. So this becomes an out of scope because the goods are supplied in Jafza. So now, does that situation remain the same? Because you mentioned about X works. In case of X works, when the goods are handed out to the freight forwarder, we have to get the exit certificate. But in this case, we are doing the transfer of ownership within Jabza, and the buyer's freight forwarder is also based in Jabza. So, do we need to get the exit certificate, or it is enough to show the transfer of ownership for out of scope transaction?
So if I understand your question correctly, you are in Javza and your customer is also in Javza.
Yeah, I am a mainland entity, but I don't have a warehouse in Jabza.
Okay.
And I'm
they
invoicing a buyer who also has a warehousing facility in Jabza. So goods never come out of Jabza. They are being transferred through transfer of ownership.
but goods are within Javza.
Yes.
So they came from outside UAE
Yes.
first.
Yes. Yes.
They came from outside UAE and you transfer the ownership within Javza itself, right?
Yes. Yes.
They never were clear into the mainland.
Yes.
And these are supplied to a customer within Javza who will be using those goods for what?
Export. It's not for consumption within Jabza.
Okay, then it's out of scope. Yeah, clear. No need to. So for out of scope treatment, you don't need to obtain an exit certificate as long as you have valid commercial evidence, which is your invoice, as well as customs evidence, evidencing the delivery of goods or exit of goods from
Okay.
Java free zone to outside UAE. Exit
Okay.
certificates is typically, which I mentioned, is was mandatory until 15th of November for export of goods, 0%. If you want to defend your zero rating. But here the transaction itself is out of scope. You don't
Yeah.
even need to report it in the return.
Yeah.
So here, first of all, it will not go to your return. If so, for out of scope supplies, anyways, don't get typically targeted until you get audited. If you get audited, you can substantially say these goods came into Javza and went from Javza to outside, which is an out of scope supply.
Just a slight change in the scenario. If the buyer is also a mainland entity, but they have it doesn't matter. They have the warehousing and freight forwarder based in Jabza, and the goods are transferred within Jabza.
Correct. So normally we get confused when the transactions come within the scope of designated zone. We must understand the supply of goods is out of scope. I don't need to consider the location where the supplier or the buyer is. I need to see
Right.
where the goods
Where the
are.
goods are. Where the
Where
goods
the
are.
goods
Right.
are. I don't need to
Right.
bother about where my supplier is located, where my customer is located. If goods are moving within free zone, within designated zone, and from there to outside, then the
Right.
supply is out of scope. No,
Okay.
regardless of who is invoicing, who is being invoiced.
Okay.
Yeah.
Thank you. Can I continue with the VAT related question because PO038,
Ek
Ekansh?
kaam karte hain, let's complete all the rounds of all questions and then we'll come back to you because there are so many questions
Okay.
which are.
Okay. Thank you. Thank you.
Jivai, like we can start with the sequence. I think Anita
Thank
is
you,
when she has
Vikas,
pushed
but
the first question.
एक minute, Sanjay bhai. Okay, hi Deepa, go ahead with your question.
Yeah, with respect to VAT, I have a question. Let's say there are 30 companies in the group, in the one VAT group, and the input and output VAT is getting recorded in the respective companies' liability and asset account. And then at the end of the month, before filing the VAT return, we reconcile all the companies' account to one account.
Mm-hmm.
Yeah, so is that an issue? I mean, because you mentioned that there should be only one account that is in the taxable company.
So I mentioned for cases where you have a separate account for VAT and separate account for corporate tax. If it is a tax group for VAT purposes, then you are registered, you have one TRN. So you will file one VAT return. Even though you may have separate accounts for each individual company within that tax group, that is fine, perfectly fine. In the end, you have to consolidate everything and file as one. The
Yes.
separate account thing which I was mentioning was related to, I have seen company ABC is having a separate taxable person account for VAT. ABC is registered for corporate tax in a separate taxable person account. For
Okay.
all taxes, every company should have one taxable person account, one email ID, one password, that's it. But I have seen cases where companies have registered in separate multiple accounts, with two different email IDs, two different passwords, so which is not right.
Okay. Okay, fine.
Yeah.
So
Got it. Thank
let's
you.
go to another one. Anita ji, please go ahead with your question. You आपको
Yeah,
आवाज
hi,
सुनाई देती है?
Kansh.
Yeah.
The question is like if the sole establishment company, person is having a sole established one business and he has floated another company, another sole establishment. By some reason, it was LLC now converted into sole establishment. For the CT registration, 1 million threshold if we take, so will both the activities be joined together and then the total revenue of 1 million will be taken as for the sole establishment, or how do we go about for the city registration?
Yes, so sole establishments, regardless of whether I have 10 sole establishments or 50 sole establishments, all sole establishments are considered as one natural person. Natural person. Sole establishment does not have any legal personality of its own. It is the natural person that it is representing. So even if you have multiple sole establishments, they will be seen as one natural person. So threshold will only apply once. You cannot apply multiple thresholds for each of those sole establishments. I hope I
Okay,
answered
so
it.
that means all the activities together will amount to 1 million and then we'll register accordingly for the
One
city.
return, one registration, everything is one
Okay,
for
yeah,
all sole establishments. Yeah.
yeah. Thank you,
You
Ikansh.
loud
No
and
problem.
clear. One registration you have to go for. Lakhani ji, please go ahead with your question. Interesting question. Let's see what exactly the reply is.
Yes, sir. The question is that the client is applying for a deregistration, and now he is realizing that there are differences between the input tax credit claim or the in some way maybe output tax is not correctly calculated, or maybe the headings are also wrong somewhere. It was not out of scope, whether he has put it under out of scope. So in this scenario, should we go for a voluntary disclosure, or should we wait for the final return, which is going to come? How do we go about it?
So file a voluntary disclosure. Don't wait for the final return.
Okay, so it is so he will have to pay some penalty, right? When he does
Yeah, of
that.
course, of course, of course. If see, voluntary disclosure penalties are very less, as I discussed earlier. So, if it relates to first year 5%, second year 10%, third year 20, fourth year 30, and then fifth year 40% of the tax amount, and then 1,000 dirham and 2,000 dirham per return for incorrect filing. So, just file a voluntary disclosure. Don't wait for the final return.
And so they are asking for details from right from 2018
Yes.
up to now.
Correct. Yes, yes. So
I
if,
cannot
if they
even.
find if they find a single input tax credit wrong,
Mhm.
they will deny it, ask you to pay it first. So in deregistration, I have one client who did not get deregistration approval from last 2 years. Every week, alarm clock brings. He sends me an email. Sir, what's happening to my deregistration? Every morning, Monday morning, I'm waking up to his email. Sir, can I? His company is closed. His company is liquidated. His trade license is no longer there. Bank account is no longer there. But He may be not even on the payroll of the company now, but he's sending me email every week. Sir, deregistration approve kara do. So deregistration will take forever to approve. That is why it's critical. Your everything is top notch and end to end correct. If not, you will drag on with it for years.
So for sir, 2018 we cannot even file a VD, right?
Yes, you cannot file a VD for before 5 years. Correct. You're right. So for
So for
2018, but have they noticed anything in 2018?
I've asked them to reconcile. They've asked me to reconcile. I've asked them to reconcile. So we are fighting that battle. But once that settles, I'll come to know. But if what if it relates to more than 5 years? Then what do I do?
See,
Before
ideally they cannot go back before 5 years if they did not issue any audit notification within those 5 years. But if that comes, like if push come to shove, then probably the end result will be to adjust everything in the final return. But to
all
the
right. So for the
cases
five
where
year, I should go for the VD, and then maybe anything comes
go
in, I'll
ahead,
go.
go ahead, don't wait for it. Yes, yeah.
Thank you
You
so
Thank
much. Really appreciate
No
it, guys.
problem, no problem.
Superb. I can see the smile on Lakhani's face. That is really good. Dilip doesn't want to go on unmute. So Dilip's question is an interesting question. He says, "Boss, VAT amount I filled correctly in the return. VAT amount was correct. The taxable amount was incorrect. Though it gives a warning, the system is giving a warning, but they missed it. And now what should we do? VAT amount is correct. Should we go for a VD or we should wait for FTA to come in? Because VAT amount was correct. Only the taxable amount is a problem for us."
This is question is out of scope for me. I have not seen, to be honest, this case. But I assume the VAT amount paid was correct. And even if the system was putting the warning that it's not correct, you still went ahead. Maybe try with a VD. Try with a VD because this scenario was not envisaged by the FTA, to be honest. And I've also not seen. Maybe try going ahead for the VD. Maybe if you are successful, but I don't see any risk, to be honest. I see zero risk because you have paid correct VAT amount to the FTA. So even if you don't do it, I don't see any major risk, to be honest. Just you can, for the sake of being compliant, try and go and submit a VD. If it is not going ahead, take a screenshot, keep it on your records, and that will serve as the basis during audits.
दिलीप जी आराम से सोइए. There is no problem with your return and you are happy. You can have a good sleep. Nagendra ji, please go ahead with your question.
Hi, thanks for the opportunity. So I have a couple of questions regarding VAT. So the first one, can we report the taxable revenue from the last quarter in the current VAT return? So like similarly, how we report VAT input, or is it necessary to file VD or to correct the previous submitted return? This is the first one.
Only if the amount of output VAT is up to 10,000 dirham, you can report in the current return. If it is more than 10,000 dirham, you will always have to file a VD.
Perfect.
Only the taxable amount, the VAT amount, right?
VAT amount, yes. VAT amount has to be up to 10,000 dirhams.
In
VAT
that case,
amount.
only we have to go for VD
If it
to
is more
correct.
than 10,000 dirham, then VD. If not, you can adjust in next year, any return.
We can include in the next return also.
Yes,
Less
correct.
than.
You can simply
Then
include it as part of your current month or next month return sales invoices. Yes.
in that case, if it is zero taxable, then that is not an issue, right? So no need to go for VD, right? I think so.
You mean as a zero rated invoice?
Yes, zero rated taxable supplies.
Then you always have to file a VD. Then you don't have an option to report it in the next tax period. As I discussed, there are four cases where you need to file a VD. One where output tax is more than 10,000. The other three cases is zero rated, exempt, emirate wise reporting. So these four cases are there. So
All right,
if any zero rated exempt transaction was reported incorrectly, you always have to file a VD.
all right. Then the second
Okay,
one.
Nagendra sir, in
Uh,
interest of time, this will be your last question, and the question you should go for is where the business is not operational and FTA is asking for clarification because there are so many questions other members also want to ask.
sure.
Go for
So
it.
there was an error in the VAT return for the year 2019, for example, let's say, which was identified by the FT in 2020-25. However, the business is no longer operational. The trade license have been cancelled, and the VAT registration have been deactivated in 2024 itself. So, can the FTA still request clarification for the business owner, who is currently residing in the UAE and operating in different business.
5 years is not over, but still, FTA wants to question the business which is not existing anymore. I can't
Yes.
सोच रहे हैं.
नहीं, मैं ये सोच रहा हूँ कि if it was deregistered last year, why is the FTA asking in 2025? You said it's deregistered in 2024. So why
Yeah,
is the FTA
2024,
asking?
but while doing some audit, so the FTA find randomly in our previous return.
Was
No,
it
but if it
deregistered
is
or was it under I mean, was it deregistration in process?
deregistration is completed or
Yes,
it's in
yes,
process?
done.
After deregistration, I have not seen, to be honest. If you have received the pre-approval for deregistration, after that you are saying you are receiving audit questions.
These are not practical actually. I'm just I have doubts, so that's why I'm asking. Do you have
नहीं
any?
sir.
All right,
Practically,
fine,
they are
thank
not
you.
asking questions. Once it is
All right.
deregistered, it's deregistered.
I have not seen, to be honest, in practice that FTA is asking questions after approving the deregistration. Before approving, they will ask plethora of questions.
Okay,
Yeah.
Interesting
fine.
question था मेरे को लगा practically हो रहा है and that's why I wanted to hear what exactly is happening. Okay, next question again, interesting question. Parik Murari he's asking. Murari Parik is asking, is reimbursement of expenses with markup, reimbursement है with markup for group companies subject to VAT? Three conditions: reimbursement, markup is also there, and it is for group companies. Is it subject to VAT?
Murari bhai, even if there is no markup, it is still subject to VAT. So it is subject to VAT with markup or without markup. So if you are reimbursing expenses, that if you have incurred an expense in your own name and then getting reimbursed from another entity which is not in the same group, then you have to issue a tax invoice to the other entity, even if you are charging markup or not charging markup.
Perfect. Next question is coming from Romson, and he's asking, what has changed in simplified invoicing? You were covering something on simplified invoicing. He's asking, what has changed? Has this been scrapped as a process, or what changed?
Simplified invoicing has effectively been scrapped for B2B supplies. Why it has been scrapped? Because now they have mentioned that you cannot issue simplified invoice after the day you make the supply. So normally for businesses, how do you issue invoices? You don't issue it on the at the time of supply. You wait couple of days, or you have, because you have 14 days, right? So now for simplified invoices, it is mandated that you issue the invoice at the time of supply. So if you don't do that, you are not eligible to issue a simplified invoice. You have to issue a full tax invoice. So for example, if you have supplied goods to a business for 9,000 dirhams, but you don't issue the invoice on the same date of supply, then you have to issue a full tax invoice mentioning the customer name, customer address, customer TRN. If it is not there, the customer will not get input tax credit.
Perfect. So simplified invoice is there, but only on the paper, practically not
For
happening.
B2C, is still there, because for B2C you will issue the invoice on the time of supply, POS
Like a
systems and everything. For B2C you can still continue. For B2B, effectively they want to eliminate it.
Okay. Next question, interesting question. Removal of sole establishment. Sole establishment, earlier they approved in 2018 as a part of tax group. Then they came up with a clarification saying, when we will tell you, then please remove sole establishment from the tax group. Now, what is the current situation? We have to do it without waiting for them, or we still wait for them?
What happened?
Why this is happening? Yeah, please go ahead.
Sorry. See, you have to remove it as soon as possible. Please don't wait for the FTA. The longer you wait, the longer hassles you are having, because you have to regularize it not just from VAT perspective, you have to regularize it from a corporate tax perspective. Sole establishments cannot be part of any tax group. As I mentioned, sole establishments belong to a natural person. Sole establishments have to be registered under Ekansh Agrawal taxable person account. Even though I have a company called Ekansh Agrawal LLC, Ekansh Agrawal LLC will have a separate VAT account. Ekansh Agrawal individual will have a separate taxable person account, and I will register all my sole establishment under Ekansh Agrawal individual name. My LLC will be separate, and all sole establishments will come under my personal taxable person account. So please remove all the sole establishment as soon as possible, and register and move them to the personal natural person's account.
Perfect. Do it. Don't wait for it. Do it now. Next question coming from Dharya. Dharya अपना धैर्य खो रहे हैं and he's asking this question again and again. He is saying, "Hello Ekansh, my company is registered in DMCC. ठीक है? Now I want to shift or re-domicile it to Javza. So he is changing the free zone from DMCC to Javza, re-domicile from that location. What he has to do? He has to go for a deregistration, or he can do it with an amendment as well. He's talking about re-domiciling from DMCC to Javza.
It's a good question. From DMCC, if you're going to Javza, see, you will have to first deregister your company in DMCC and again make a new company in Javza, because in my knowledge, there is no concept of transfer of company from one free zone to another. You have to first close it, deregister and everything, and then open a new company in Javza and carry on with new compliances. So this is how it is. I mean, I know it's a bit difficult, but you will have to go through the rigorous process of deregistering, closing everything. Had it been a branch, the things would be different. But if it is a separate entity which you are making in Javza, then you will have to go through the entire process of deregistering and then re-registering the new company in Javza.
I guess Dhari knew about it. He was thinking कि आप कुछ solution देंगे, but I think the process remains the same. Shweta का question है, and this is again a straight question and a painful one. They had a tax group. They went for a deregistration process because by mistake, instead of adding branches, they added it as a separate entity. The branches were added as separate entity, and tax group was created. Now the deregistration is in process. You talked about 2 years. They are struggling for 3 months. What to do? My imports are in hung status. I'm not able to import. So what is your advice? Can you do something about it?
Can't like expedite it. Of course, FTA will take its own sweet pace. I mean, imports, why they are stuck? I mean, you can still use the same tax group TRN, right? You can continue to use it until it's deregistered. So I don't see any problem with imports.
But are you there? I mean, let me take you on the call. It's an interesting one. Are you not able to do imports? Sweta, do you want to come on board? And I guess yeah. Sweta, go ahead, please.
Yeah, so basically we can't import because the pre-approval has already been received for the deregistration.
Pre-approved is done.
Okay, pre-approval receive. Okay.
Hence,
Then
we
you
are
have to
stop charging VAT.
So then you have to see. I understand. I understand this branch. So you registered this branch with other legal entities.
Yes, as a tax group we had formed.
How many entities are there in the tax group?
3.
3 entities are there, and one of the branches of one of those entities was added as a separate legal entity.
Correct.
So just if it is deregistered, then it's perfectly fine. You don't need to register it again, because this is branch is effectively part of the legal entity which is already registered for VAT. So just use that TRN, the same TRN, for importing in the branch.
So the group TRN you are suggesting?
Yeah, because the group TRN already includes the head office of that branch, right? So
No, but
the entity that the branch belongs to is already part of the tax group, right?
Correct, but we have already applied for deregistration, so we have received a pre-approval. We have filed the final return. So now, if we are not able to issue VAT, charge VAT, neither we are unable to use the TRN which is active right now.
Sweta, आप एक काम कीजिए, for next 7 days, go to FTA office in DIFC. Trust me, it's not a joke. Go there, show them that this is already pre-approved and my entire business is hung. We have done for a few of the clients. It's working, but you have to go at least for 7 days. One more advice: try to catch hold of one single person in that office, in that FTA office, customer care, and interact every day with him.
Okay.
5 days he will not react, 6 days he will react. That is the only solution.
Okay.
Okay. Yeah. Capture one person, look at that FTA guy and go every day and show that this is already pre-approved and I'm not able to complete it. 6 days you have to do it minimum, rigorously.
Okay.
And do your prayers before you go. Puja karni bahut zaruri hai. Okay, I go to the next question. Sivani, interesting question, Ekans. Sivani is saying company and B are in designated free zones. Both companies are in designated free zones. Company A is importing goods. So company A imports from outside the world. A sells to B and then B exports to outside country. A imported, A to B, B to... Okay. His question is, I am going for refund and I'm not getting refund. I think you already answered it because it is out of scope. He's not getting refunds for the sales.
No, out of scope also you can get. I don't know why you did not get any reason, specific reason you got it denied.
Shivani, let me bring Shivani on board if she's here. Yes, she's there. Shivani, go ahead with your question. I guess he does not want to come online. Okay, we have to skip that. So, Shivani, you can get refunds. That is the verdict of the experts. Moving on to class 2 questions, and then we'll conclude. What is the threshold to judge that an entity within the tax group is not active and need to be removed? Any thresholds to judge that a member in the tax group is not active and has to be removed?
If it has ceased conducting any business, so long as you can substantiate that that entity has some taxable supplies which you are reporting in the tax group return, this entity is incurring certain expenses. If it has zero expenses, zero sales, then FTA can ask you to remove it from the tax group. Will ask you most likely.
If it has only expenses,
then also you can keep it.
then
Because that shows that you have business going on. Sales you may have in one tax period or not having in another tax period, but at least expenses you can have in most tax periods, which will defend your right to substantiate that that entity is conducting business, and in the future you may have a potential taxable supply.
Does this also hold good if the expense is for 12 months without any revenue for that member company in the tax group?
For that member company, no. So once you're part of the tax group, see, anyways, all the expenses. Sorry, I was not moving, so the light went off. So anyways, the expenses will not matter the amount of expenses, because anyways you're part of the one tax group, one single taxable person. You just need to defend that entity is conducting some business. That's it.
Defend that. Okay, perfect.
Yeah.
One last question because it's already 8:40. Tajun's question is: a PR agency is raising an invoice on the hotel property. Okay, a PR agency raising an invoice on hotel property in Maldives for promoting the Maldives hotel. The audience are based in UAE. Would this attract 5% VAT? PR agency raising invoice on a hotel property which is in Maldives, but this property in Maldives is owned by a person in UAE, by a corporate in UAE. Audience also is in UAE. What will be the taxability? 5%, 0%, out of scope?
Reach out to me on email. But on this point, I was trying to put it as background to my advice. This is providing marketing services.
PR
Are
is
you there?
basically marketing and promotional services, I guess. Taijun is there. Let me bring him on.
So if you are providing marketing services to a hotel based out of UAE, first of all, I don't need to look at where the hotel is. I need to look at where my customer is in this case, because marketing services are not considered as real estate related services. These are considered as generic services. So if you are billing for those services to an entity within the UAE, then for sure you cannot zero rate it. It will always be 5%. But if you're billing to an entity which is outside the UAE, then for sure you can zero rate, subject to meeting other conditions. But other conditions should also be met, because this is not a real estate related service. Marketing service is a generic service.
Taijun is here to clarify the question. Taijun sir, what is this PR agency doing?
So it's basically, can you hear me?
Yes, please.
Yeah, so it's basically marketing the product, so marketing the property. The property is not in the country. So it's, say, for example, Sheraton in Maldives, but it is doing the audience is based in the UAE, but the invoice is going to be raised on the hotel property in Maldives. So invoice is not being raised on anyone in the UAE.
What do you mean by audience in the UAE?
So when they do a road show and then they would do promoting the property, that would be done in the UAE. So they are basically wanting to sell Maldives to the tourists in the UAE.
See, if you're purely providing marketing support and not conducting events as such, if it is pure marketing advertisement services on social media and everywhere, and you're billing to a hotel located outside the UAE, then it
That's
can be
right.
zero rated. But if you are conducting an event in the UAE to promote their product, then you will not be able to zero rate, because then it will become an event specific service. And if event is conducted in the UAE, even though you are billing to a non-resident entity, then you cannot zero rate. You will have to charge 5%.
Okay. Okay. Understood.
Perfect.
Thank you.
One last question. I guess we were able to address all the question. It is coming from Johnson. It says, I have a company in Rakis, and that is also in designated zone in Rakis ke andar. I have imported some goods in Zavza, and then from Zavza it is going to Rakis. So goods are coming to Zavza first. From there, under custom suspension, it is going to Rakis. Am I liable to pay VAT on these goods? If yes, should the company register for VAT if the import value exceeds 375?
So you imported goods in Javza and then moved them from Javza to Rakesh, right?
Yes.
And
Under custom
cus-
suspension.
yeah, under custom, if the goods moved within designated zones, Edson, correct me if I'm wrong. If you're moving goods within designated zone, then it is not considered as imported into the UAE. It will still be considered as outside the UAE, even though you're moving, because when the goods are moved from Javza to Rakesh, they will be sealed. They put a seal so that you cannot open, or you can manipulate with the goods during the transit. So it will be seen as if they are part of the designated zone itself. So the taxability does not trigger.
Perfect. Johnson, you want to add something there? Are the facts correct? You are okay with the solution? Johnson? Okay, you are unmuted, but we are not able to hear you. So that's it. That's the end of it. And before we wrap it up, let me bring the guy who did this for you, who started this. Where is he? Sanjay Bhai, are you there?
Of course, I'm here.
Yes, sir. Please go ahead. Thank you very much, Akansh. And now I'll hand over to Sanjay to close the session formally.
Yeah, first of all, thank you to Akash, because I was just, I mean, because of his hectic travel schedule and the corporate time going on, but he accepted our invitation and connected with even the Edson also. It's really valuable insight, and more than around 200 people were there at the time. And second is exercise we left out this time, but again we'll organize one more session exclusive for exercise. I think that's again more going to be interesting session. Thank you once again, Akash and Edson, and
Thank you,
have a great
everyone.
evening, everyone. Thank you.
Thank you.
Thank
Have a
you,
great
everyone.
evening.
Sushil ji, you can
Bye-bye.
connect with Akansh. Akansh is our member for your question on clarity on PO038. In interest of time, हम close कर रहे हैं. But if you need his number, call me and I'll give you Akansh's number. Thank you.
Thank
Thank you,
you. Thank
everyone.
you, Jay. Thank you, Sanjay ji.
Thank
Thank you.
you.
Thank you, everyone.
Thank
Thank
you.
you.
अच्छा
Bye-bye.
अमित था क्या? मेरे को लगा खाना
Yeah,
खा रहा
yeah. Actually, I'm just handling some other duties, you see.
है. अच्छा छुटका से परेशान कर रहा है.
I'm
चलो.
on some other duties. So it's very well moderated by you, Jay Bhai, and Ekansh and Edson. It was wonderful session. And, it was so evident that, the
इसका
chat
छोटा तो
box was
चेहरा तो
keep
दिखाओ.
buzzing in.
इसके बाल ही
Sorry?
दिख रहे हैं. इसका चेहरा तो दिखाओ, इसका बाल ही दिखा. हाँ ये शाबाश लग रहा है.
So my wife is taking the dinner, so now I am on the second duty. That's how the beauty of the online sessions.
चलो.
So good night,
Okay, bye.
everyone, and thank you
Good
so
night,
much.
everyone.
Thank you.
Thank you. Bye
Thank
bye
you,
bye.
everyone. Cheers. Bye bye.